Political Economic Watch and conversation continues in Nigeria. Here is a lineup for this edition. We'll bring you the outcome of the 274th Central Bank of Nigeria Monetary Policy Committee meeting, process analysis on the CBN July 2020 MPC, PFI capital analysis on Nigeria's inflation trend, the NIPC's first half of the year 2020 Nigeria Investment Report, excerpts from the recent G20 forum meeting of finance ministers and central bank governors. First, let's bring you the outcome of the 274th Central Bank of Nigeria MPC meeting, which had 10 members of the committee in attendance yesterday, July 20th, 2020. The committee reviewed the policy options before it and argued that the option of tightening at this time will contradict the noble initiative of expansion of affordable credit to the real sector, noting that this would heighten the cost of production, which would translate to higher prices of goods and services and harder economic conditions for people. On the other hand, loosening monetary stance would provide the desired succor for stimulating output growth and rapid recovery, but with implications for domestic private investment and capital mobilization to support huge domestic financing gap. Further cuts in the monetary policy rates may not necessarily lead to a corresponding decrease in market interest rates, the MPC said. Considering the current economic challenges in the country, the committee was also mindful of the cut in policy rate at the last MPC meeting and the need to allow time for the transmission effect to permeate the economy. Given the plethora of monetary and fiscal measures recently deployed by the Central Bank of Nigeria and federal government to address the impending economic crisis following the COVID-19 outbreak, it will be a relatively cautious option to hold in order to evaluate the effectiveness of these tools at addressing the current challenges, particularly with the mounting uncertainties within the domestic economy as well as the external vulnerabilities. After reviewing the three options, the MPC noted that the imperative for monetary policy at the May 2020 meeting was to strike a balance between supporting the recovery of output growth and reducing unemployment while maintaining stable prices. The committee noted at this meeting that the economic fundamentals have marginally improved by the end of June 2020, following the gradual pickup of economic activities as the positive impact of the various interventions permeates into the economy. As a result, the committee noted that the earlier downward adjustment of the MPR by 100 basis points to 112.5% to signal the loosening monetary policy stance is yielding positive impact as credit growth increased significantly in the economy. The MPC also noted the positive impact of various fiscal and monetary interventions on households, small-medium enterprises, and manufacturing sectors. The committee also noted that the increasing MPR at this stage will thus be counterintuitive and will result in upward pressure on market rates and cost of production. In view of the foregoing, the committee, led by the Central Bank Governor, Mr. Godwin Emefiele, decided by a majority vote to retain the monetary policy rate at 12.5% and to hold all other policy parameters constant. In clarity, the committee decided by a vote of 8 members to hold and 2 members voting to reduce MPR. All members voted to retain all other policy parameters. And in summary, according to the Central Bank of Nigeria Governor, the MPC voted to retain the MPR at 12.5%, retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR, retain the cash reserve ratio at 27.5%, and retain the liquidity ratio at 30%. Those are the key decisions from the Monetary Policy Committee of the Central Bank of Nigeria after their meeting yesterday, which meant Nigeria is holding its rates and watching cautiously the developments in the economy. Don't forget, Nigeria's current GDP growth is 1.87%, misery index is 55.3%, and its unemployment remains 23.1%. And so let's get on to other developments and analysis on the economy. As we all know, this period is a challenging time for the country, and ProShare has also brought out its analysis on the economy, analyzing the rates of impact of the recent monetary policy decision taken by the administration and also the Central Bank of Nigeria Monetary Policy Committee meeting. First, looking at the issue of inflation, The ProShare research team in its analysis said inflation uncertainty is becoming a growing concern for investors, savers, and consumers alike, as the domestic inflation rates in June 2020 settled at 12.56%, with the savings rate between 2 and 3%. The negative return on bank saving products floats between minus 9.56% and minus 10.56%. The meaning of this is that within 7 years, or by 2027, the amount in savers accounts will be worth exactly half of their values in 2020. But the need to tackle inflation in 2020 appears less of a priority for the monetary authorities, and is the need to grow the gross domestic product, that's the GDP, to counter the rise in the jobless rates. When we look at that, there are no contemporary figures available apart from the current 23.1% presented by the National Bureau of Statistics in third quarter 2018 and corporate bankruptcies. The domestic inflation rate has grown steadily for the last 10 months and has more recently settled at its highest rate in the last 24 months. Despite holding the MPC policy rate constant for a term, the domestic inflation rate may not abate anytime soon, as supply chain challenges, rising import costs, falling purchasing managers index, which is currently at 41.1% as of June 2020, suggests cost-push inflationary pressures in third quarter and perhaps fourth quarter 2020, but reduced consumption spending caused by higher jobless rates and lower consumer disposable incomes may lead to less demand pull strains. If the economy expands a bit in third quarter and fourth quarter of 2020 as a result of an easing of lockdowns and restricted interstate transport movements, the domestic inflation rate may begin to taper downwards as gross domestic product growth picks up a notch. ProShare research says the projected minus 4.2% shrink in Nigeria's GDP by the International Monetary Fund may be off the mark by a few basis points, as first quarter GDP growth showed plus 1.87% growth, which was ahead of the earlier IMF projections, even though it was below the first quarter 2019 growth of plus 2.1%. Analysts expect inflation to arise at a slower pace over third quarter and fourth quarter 2020 as long as farm gate produce is allowed to move to urban centers and transport costs do not escalate. Energy costs are not expected to rise until first quarter of 2021. It also takes a look at the incredibly shaky GDP, looking for a bootstrap. According to ProShare research, GDP will likely slip in second quarter 2020 for Nigeria as slowly reawakening manufacturing activities, weak recovery of supply chains, and slow consumer spending will combine to drag down GDP growth. To make matters worse, low international oil prices and a cut in oil production, as advised and monitored by the Organization of Petroleum Exporting Countries in both third and fourth quarter 2020, will hurt Nigeria's oil revenues over the next few quarters. Although the CBN has noted that non-performing loans in the banking sector declined to 6.4% at the end of June 2020 from 9.4% in the corresponding period of 2019, the narrative may change shortly as the banking sector becomes hard hit by the fall in international oil prices. The largest part of the Tier 1 deposit money bank's credits goes to the oil sector, shows huge exposure there. In this context, banks may become more conservative as they de-risk their balance sheets and gradually unwind their oil and gas exposure. The rise in domestic inflation rate has rattled real disposable income and local consumption, thereby nibbling down on growth in second and third quarter and possibly the fourth quarter. With the forecast decline in investment in the real sector, Nigeria's GDP is expected to contract further in second quarter 2020, dropping from 350 billion naira in the first quarter. And of big interest, trade wars and current account imbalances. A gray area, according to the ProShare research team, which the Central Bank of Nigeria failed to address during the MPC, was the outlook for the exchange rate. The CBN said it will unify its multiple exchange rates, and this has resulted in the devaluation of the naira in the import and export window to 381 naira to $1. The persistent rise in inflation and the devaluation of the naira would most likely worsen Nigeria's trade balance. This means that companies in Nigeria that depend on the import of raw materials in their local production value chain would pay higher costs. for inputs. And this will be of utmost concern to business operations as we enter the third and fourth quarter. Looking at the way forward, Central Bank of Nigeria will face a tough task, according to ProShare Research, in keeping the economy on an even keel over the next 2 quarters, as the higher the rates of domestic inflation, falling fiscal revenues, and foreign exchange earnings and rising jobless rates will conspire to weaken and make the monetary policy, as the Central Bank of Nigeria has little headroom for further policy adjustments. The fiscal authority also has a slim wiggle room, as the country's high debt service profile and escalating debt size means that the borrowing window for fiscal authority is slowly closing shut. Top of the agenda of the Central Bank's of Nigeria's next MPC should be likely to be issues around the exchange rates. The persistent rise in inflation and the likely contraction of the economy. As noted in the MPC, the Central Bank of Nigeria decided to retain its MPR at 12.5%, citing the need to allow time for transmission effect of its policies to permeate the economy. However, the shape and pace of the economy over the next few weeks would prove instructive to economic stakeholders, as the CBN still water approach to key policy metrics would have begun to leave notices of policy strength or weaknesses. To be sure, doing nothing at times could prove to be a brilliant counterpoise to doing the wrong thing. Let's take that again. To be sure, doing nothing at times could prove to be a brilliant counterpoise to doing the wrong thing. So that's a cautious approach the Central Bank of Nigeria is taking, according to ProShare Research. And we will be here monitoring the impacts of this no action step by the Central Bank of Nigeria, holding all the rates and watching cautiously as the impact of its policy transmission permeates the economy. Let's hope that it will be much better for our economic stabilization as we continue to navigate this unprecedented pandemic in the country and globally. From PFI Capital, it gives its own analysis on the June 2020 inflation rate report and shows the trend of Nigeria. From PFI, it says that the headline inflation rate rose for the 10th consecutive time, this time to 12.56% in June. This was 16 basis points higher than 12.4% recorded in May 2020 and 134 basis points ahead of the 11.22% recorded in June 2019. On month-on-month basis, the headline inflation rate increased by 4 basis points to 1.21% from 1.17% recorded in May 2020. This is the slowest month-on-month increase since February 2020. The rural inflation rate was up by 3 basis points to 1.19% month-on-month, while the urban headline index rose by 5 basis points to 1.23% month-on-month. PFI Capital notes that the increase was recorded in all the 12 COICOP divisions that make up the index, with prices of bread and cereals, potatoes, yam and other tubers, fruits, oils and fats, meats, vegetables and fish recording the highest increases as components of the food index, when compared to 15.04% recorded in May 2020. The food inflation rate accelerated by 14 basis points to 15.18% year-on-year, but by 6 basis points month-on-month to 1.48%. Core inflation, on the other hand, was up marginally by 1 basis point to 10.13% year-on-year and was down by 2 basis points month-on-month when compared to the 0.88% recorded in May 2020. The highest increases were recorded in the prices of hospital services, medical products and services, as well as transportation products and services. On a state-by-state basis, headline inflation was the highest in Bauchi, Sokoto and Ebonyi states at 15.02%, 14.88% and 14.6% respectively. Cross River 10.95%, Lagos 10.78% and Kwara State 10.03%, however, recorded the slowest rise in headline inflation year-on-year. PFI further notes that food inflation in June 2020 was highest in Sokoto, as it recorded headline inflation of 17.88%, followed by Plateau State, which recorded 17.04% inflation rate year-on-year, and Abuja with year-on-year headline inflation rate of 16.82%. On a quarterly basis, PFI highlights that headline inflation in second quarter 2020 was the highest of the 6 quarters reviewed, and they note disruptions to supply chains caused by the global pandemic was a major factor for cost-push inflation over the period. PFI thinks the waning purchasing power of consumers brought about by a decrease in income would reduce inflationary pressures in the coming months. This is to say that the rate of increase in the headline inflation rate will slow down from July through to October 2020 before seasonality factors take effect in November and December 2020. That is the analysis from the PFI Capital on Nigeria's inflation rate. And now for the Nigerian Investment Promotion Commission, we'd just like to see what has happened in the first half of the year in the area of investment announcement, and they track it very well. For the NIPC, the first half of the year saw about $5.06 billion worth of investment announcements in the country. And this was 67% less than the value in first half of the year 2019, the corresponding period, which was $15.15 billion US. The decline is consistent with expected downward pressure on investment flows, given the negative global economic impact of COVID-19. The Commission continues to send out its NIPC intelligence newsletter 6 days a week and tracked a total of 34 projects across 16 states, the FCT, and the Niger Delta region from January to June 2020. The top destinations during the period were Kaduna State with $2.61 billion investment announcements, Lagos State with $221 million investment announcements, Nasarawa State with $56 million investment announcement, Ekiti State with $50 million investment announcement, and Cross River State with $15 million investment announcement. Similarly, the top 5 sectors were transportation and storage, information and communication, 32%, mining and quarrying, 22%, finance and insurance, which was 68%, agriculture, 20%, and finance and insurance, 3%. The United States of America was the most active source of investment during the period, with 43% of the announcements. The other major sources of investment were South Africa, 31%, while domestic investors were 16%, and the United Kingdom were provided 8% of the investment announcement captured by the NIPC. NIPC's intelligence newsletter calls Nigeria's investment-related news from various reported sources. The report is based only on investment announcements cited in NIPC's newsletters from January to June 2020, and it may not contain exhaustive information on all investment announcements in the country during the period, but is also a source of information that can be tracked. Nevertheless, the report gives a sense of investors' interest in the Nigerian economy, and NIPC did not independently verify the authenticity of investment announcement, but is working on tracking the announcements to facilitate their progress to actual investment actualization. Let's get on to G20, very, very vital group globally. Economies that are industrialized, economies that are tracked as emerging economies, leading GDP, population, and advancements. They had a recent meeting, and it was the meeting of the G20 finance ministers and central bank governors who met to discuss how they can support the stabilization of global economy post-COVID-19, and also agreed on various steps to be taken. So let's take out some of the key steps, which is lengthy but very important for us to take note of. First is that the global economic activity is expected to contract sharply in 2020 due to the impact of COVID-19 pandemic and the associated disruptions in the supply and demand. While the outlook remains highly uncertain and is subject to the shifts and challenges that have been driven by uncertainty and elevated downside risk. Global economic activity is expected to recover going forward as economies gradually reopen and the impacts of the significant policy actions materialize. The G20 is determined to continue to use all available policy tools to safeguard people's lives, jobs, and incomes, support global economic recovery, and enhance the resilience of the financial system while safeguarding against downside risk. G20 is taking immediate and exceptional measures to address the COVID-19 pandemic and its intertwined health, social, and economic impacts, including through the implementation of unprecedented fiscal, monetary, and financial stability actions, while ensuring that international financial institutions and relevant international organizations can provide critical support to emerging, developing, and low-income countries. The global landscape continues to be rapidly transformed by economic, social, environmental, technological, and demographic changes. Working together, G20 will continue and strengthen as necessary these efforts to support a fast and robust recovery to achieve strong, sustainable, balanced, and inclusive growth while making the most of current transformations in shaping the recovery in a way consistent with the pre-crisis agenda. In terms of fiscal and monetary policies, they will continue to operate in a complementary way for as long as required. Monetary policy will continue to support economic activity and ensure price stability, consistent with the central bank's mandate. The G20 will continue to facilitate international trade, investment, and to build resilience of supply chains to support growth, productivity, innovation, job creation, and development. The G20 will continue to take joint action to strengthen international cooperation and frameworks. The G20 Action Plan endorsed at the last meeting on 15 April 2020 sets out the key principles guiding the response and commitments to specific actions to drive forward international economic cooperations as the G20 navigates and the crisis alongside other countries in the world. They look ahead to robust, sustained, and inclusive global economic recovery and have made substantive progress in implementing the G20 Action Plan and endorsed the first G20 Action Plan Progress Report, which provides information on monitoring action plan commitments, including the progress made and the way forward to support the global economic recovery, while enhancing resilience against future shocks, including pandemics, natural disasters, and environmental risk. G20 reiterates its agreement that the G20 Action Plan is an economic situation, recognizing members are in different stages of responding to the crisis and that the global economic outlook continues to evolve. Further steps are needed, and in particular the third pillar of the G20 Action Plan, which is returning to strong, sustainable, balanced, and inclusive growth once containment measures are lifted. This provides the basis for cooperate in support of global economic recovery. Building on previous commitments made by G20 and taking into account discussions at the upcoming joint meeting of the G20 Finance and Health Ministers, the relevant groups to develop an updated G20 action plan that will be presented to its next meeting in October 2020 ahead of the G20 Leaders Summit in November 2020. It affirms its commitment to regularly reviewing, updating, tracking, and following up with the implementation and report of the G20 action plan. The COVID-19 pandemic has reinforced the need to enhance access to opportunities for all. G20 will continue to its efforts to reduce inequalities, reaffirming its previous commitments to promoting an inclusive growth for its members and across the globe. It will also continue to address the disproportionate impact of the crisis on the most vulnerable segments of society. In this context, the G20 endorses the menu of policy options to enhance access to opportunities for all as a valuable set of policy options that can be leveraged to support the immediate response to the COVID-19 pandemic and move towards a strong, sustained, balanced, and inclusive recovery. G20 also welcomes the progress achieved under the Debt Service Suspension Initiative, which as of July 18, 2020, 42 countries had requested to benefit from the DSSI, accounting to an estimated $5.3 billion of 2020 debt service to be deferred. The International Monetary Fund and the World Bank Group have proposed a fiscal monitoring framework and a process to strengthen the quality and consistency of debt data and improved debt disclosure to provide maximum support to DSSI-eligible countries. G20 will continue to closely coordinate in its implementation, and this includes all official bilateral creditors, which will have to implement this initiative fully and in a transparent manner. While protecting their current ratings and low cost of funding, multilateral development banks are encouraged to go further on their collective efforts in supporting the DSSI, including through providing DSSI-eligible countries with net positive financial flows over the suspension period of the DSSI, and further details on the new money provided to each eligible country. G20 takes note of the International Institute of International Finance, IIF, terms of reference for voluntary private sector participation. It notes the need for further progress and strongly encourages private creditors to participate in the DSSI on comparable terms when requested by eligible countries. G20 will consider a positive extension of the DSSI in the second half of 2020, taking into account the development of COVID-19 pandemic situation and the findings of a report from the International Monetary Fund and World Bank Group on the liquidity needs of eligible countries. This will be submitted to the G20 in advance of its meeting in October 2020. It will also look forward to an update on the implementation of the IIF's voluntary principles for debt transparency, including on work to identify a data repository. G20 will also remain determined to act swiftly, individually and collectively, including through IFIs, to safeguard financial stability against short-term risk while strengthening long-term financial resilience and supporting growth, including through promoting sustainable capital flows and developing domestic capital markets. The G20 welcomes the high-level ministerial conference held by the G20 and Paris Forum on the 8th of July 2020, which focused on tackling the COVID-19 crisis, restoring sustainable flows of capital, and robust financing for development. Discussions helped to inform the work that's been done on these issues. It reiterates its commitment to ensure a stronger global financial safety net with a strong quota-based and adequately resourced IMF at the center, and will keep demands on the IMF resources under close review. It welcomes the actions taken by the IMF in response to the crisis and welcomes the immediate financial contributions pledged to strengthen the IMF crisis response capacity to address the critical funding needs of low-income countries and call for more and urgent contributions. G20 also calls on the IMF to explore additional tools that could serve its members' needs as the crisis evolves, drawing on relevant experiences from previous crises. It acknowledges that infrastructure is a driver of growth and prosperity and is critical to promoting economic recovery and resilience, and can be further enhanced through the use of technology. It endorses the G20 Riyadh Infratech agenda, which promotes the use of technology in infrastructure, with the aim of improving investment decisions over the life cycle, enhancing value for money of infrastructure projects, and promoting quality infrastructure investment for the delivery of better social, economic, and environmental outcomes. In line with the G20 roadmap for infrastructure as an asset class, it welcomes the G20 and OECD reports on collaboration with institutional investors and asset managers on infrastructure investment, which reflects investors' view on issues and challenges affecting private investment in infrastructure and presents policy options to address them. It looks forward to continuing the work through a structured collaboration in a flexible manner with the participation of interested multilateral development banks and international organizations. It welcomes the progress made so far and will advance the work related to the G20 principles for quality infrastructure investment, including to the member-led case study survey and the continued exploration of possible indicators. It recognizes the need to better inform infrastructure investment decisions through the ongoing work on access to data. G20 will continue its cooperation for a globally fair, sustainable, and modern international tax system. It acknowledges that the COVID-19 pandemic has impacted the work of addressing the tax challenges arising from the digitalization of the economy. It stresses the importance of the G20 OECD inclusive framework on base erosion and profit shifting to continue advancing the work on a global and consensus-based solution with a report on the blueprints for each pillar to be submitted to its next meeting in October 2020. It remains committed to further strengthening and commitments to both pillars of overcoming remaining differences and reaffirming its commitments to reach a global and consensus-based solution this year. It welcomes the progress made on implementing the international agreed tax transparency standards and the progress made on the established automatic exchange of information, as well as its advancement marked by the agreement on the model reporting rules for digital platforms for interested countries. It welcomes the annual BPS progress report of the G20 and OECD Inclusive Framework on BPS. It also welcomes the progress report on the platform for collaboration on tax and continues its support to developing countries in strengthening their tax capacity to build sustainable tax revenue bases. It reiterates its commitment to the 5 principles set in the Financial Stability Board (FSB's) report on COVID-19 to the G20 in April 2020, which underpins national and international response to COVID-19 pandemic. G20 welcomes that these responses have been largely in line with and have reconfirmed commitments to international standards. It welcomes the FSB's update on COVID-19, highlighting financial stability, implications, and policy measures taken. It asks the FSB to continue monitoring financial sector vulnerabilities, including those related to liquidity, solvency, and pro-cyclicality, with special attention to situation of non-financial corporates and coordinating and communicating clearly on regulatory and supervisory measures among its members, jurisdictions, international organizations, and standard-setting bodies. It will support using the existing flexibility within international regulatory standards, including on the use of capital and liquidity buffers, without compromising on the previously agreed reforms. It will continue to consider how to safeguard the banking sector's loss absorbency and lending capacity, including through its approaches regarding constraints on dividends and share buybacks, taking into account country circumstances. G20 welcomes the FSB plan to carry out by November 2020 a holistic review of the market conditions that prevail during March 2020, including the implications by the non-bank financial intermediation sector, NBFI, drawing on the work by the SSEs. It welcomes the public consultation report on the FSB's evaluation of the effects of too-big-to-fail reforms, which highlights the significant benefits of these reforms and the need to further work to address remaining obstacles to resolve the G20 group of ministers. The FSB, from its perspective, is continuing to examine the financial stability implications of climate change, and it welcomes growing private sector participation and transparency in these areas. These are some of the very key, interesting discussions and talks raised at the G20 Finance Ministers Forum. And just to let you know that, yes, in this period in the country, we're seeing the quest for transparency and accountability in various critical institutions and regional development agencies in the country. Some of them include the anti-graft agencies like the Economic and Financial Crimes Commission, the regional development commissions like the Niger Delta Development Commission, and also the National Social Insurance Trust Fund. In the course of our programs in subsequent editions, as we discuss, we'll look at this in a very analytical, data-driven manner, as we know that this is very important for our country. Transparency in institutions and how funds are managed are very critical, because when they are not managed properly, it has adverse effect on the populace. And so that is of importance to us, and we will move beyond the grandstanding to take the key facts and what are the issues and how it affects our economy. So that will be part of our focus in subsequent editions as we look at these institutions and how they can work better for the good of the whole nation. And that will be a wrap for the Economy and Politics show for this very special day, Tuesday, July 21st, 2020. Please send your comments and views to news@proshenji.com. And also join our website, www.proshenji.com, to watch our videos, read our news reports, and analysis. This period, we want you to note that in every conversation you have about political economy, if it's a debate, if it's an argument, it's a conversation, let's make it constructive and productive. We need to avoid abusing ourselves on platforms. We need to have matured conversations. That is why the Economy and Politics show is one avenue for you to get data, facts, analysis that helps you to engage properly. Thank you for watching, and yes, wishing you a very nice day. And by 10 a.m., a market review will be on, and you don't want to miss what's happening in the financial and capital market as it relates to the economy. Stay tuned till then, but I want you to know that in this period, you have to stay safe, to stay alive, and wish you all the best. Thank you for watching.